Home prices are about to crash as confidence plunges and construction is halted. I'm your host, Steve Van Metre, and thanks for joining me today. It appears that meltdown in the housing market is finally starting, and the question is it a function that interest rates are too high? Is it the stock market? What's the catalyst? Well, you might be surprised to find out. Let's pick today's story up with this headline: that the housing market meltdown intensifies, home builders halt construction as confidence plunges to a 2-year low. Builder confidence in the market for new homes posted 7th consecutive monthly decline in July, falling 12 points to 55 for its second biggest single-month drop in history, according to the NAHB Wells Fargo Housing Market Index released on Monday. And just so you understand what these data points mean, it's just like the diffusion indices. When it's at 50, it's unchanged from the prior month. When it's over 50, it means expansion. Under 50, contraction. Now, in the history of the housing market, we don't get too many contractions. So when we see it fall down to a 55, it means it's slowing and slowing quickly. Let's continue on, because I want you to see here where these peaks are at in this NAHB Housing Market Index. And you'll notice that there are occasional plunges. We've seen this, of course, notably the pandemic one. We'll just kind of ignore that one because it wasn't a normal drop. And you'll notice it's not that common, particularly in the 2000s. We see the index dip slightly below 50, but continued higher. But what is the catalyst behind these peaks? Well, many think it's interest rates. So let's take a look at 30-year Treasury yields, which is a barometer for mortgage rates. And I circled the same data points, and you'll notice it doesn't correlate with periods where yields are abnormally high or in their cycle at their high. You can see here in the 80s, they were higher. In fact, here in 94, they were actually lower. And into the late 90s, they were actually headed higher. And even here in 2006 and then 2020. So we'll say that it's not yields, but maybe it's when it actually breaks that 50 level. Well, let's take a look at where yields were at then. And no, the answer is certainly that's not really it. Maybe we could make a case here for 94, but even then rates were higher prior to that. So it's not really a function of interest rates as most people believe. How about the equity market? Well, let's take a look at the Wilshire 5000 on a year-over-year rate of change. And do we see peaks perhaps in the equity market that are driving this? And the answer is, well, sort of, but not really. You could make that case here in the 80s where the year-over-year rate of change went negative following a peak in the NHB indice. We see here where in yellow where it fell below 50. But notably, here in 94, well, they were already there. The equity market was already running negative on a year-over-year rate of change. So again, no correlation really, or at least a strong correlation with the equity market. So what is it? Is it the Fed? Well, maybe it's something the Fed is doing that we can actually see, and that is the yield curve. And this is where you take the 10-year Treasury yield, subtract 2-year Treasury yields, and notably, where I've circled is where we see those peaks. And certainly enough, we notice, of course, actually not the peaks, the breaks at 50, and you'll notice all of this happens when the yield curve is close to or near inversion. And look what's happening now to the housing market. It's suggesting that prices are indeed coming down. Are they? Well, we'll look at a chart on that in a moment, but let's continue on with the story, because the NHB, well, it wasn't very good what they had to say. The report also showed home builder expectations for both current and future sales have dropped sharply, pushing confidence to its lowest level since May of 2020. Of course, you remember that was in the pandemic lows of the data point here recently, and that's not good news either. And the statement explained the battered sentiment. NHB Chair Jerry Conter said production bottlenecks, rising home pricing, building costs, and high inflation are causing many builders to halt construction as the cost of land, construction, and financing exceeds a home's market value in some cases. And what that means is the cost to build a home is perhaps more than it will sell for. That's not normal. That's not what you expect to see happening, telling us that there's prices are softening and even starting to come down in some places. Also hurting confidence, increased interest rates, which we just debunked, that's why I wanted to show you that early on, have driven up the cost of new mortgages by hundreds of dollars each month, and on average dramatically slowing sales and buyer traffic. But the reason that doesn't make any sense is because if the economy is booming, and again, this is what we're being told by the Fed and other policymakers, then affording higher borrowing costs because wages are rising should be a non-issue, and that's why you tend to not see high interest rates lead to a peak in the housing market, because they should actually be going together. If the housing market's booming and the economy is booming, rates should be rising and people should be able to afford them. In an emailed comment, Pantheon Macro Chief Economist Ian Shepherdson said confidence has further to fall, noting that Federal Reserve Chair Jerome Powell last month alluded to the housing market's complicated situation, saying potential homebuyers need a bit of reset as mortgage rates normalize at higher levels after remaining historically low during the pandemic. This is a meltdown, he says, noting home prices should soon start to drop, and warning, pretty soon anyone who's bought a home in recent months will be sitting on a loss. And there's a lot of truth to that. In fact, if you're concerned at all what a housing-led downturn in the economy could mean to your portfolio, well, you shouldn't be. There's one that stands true during recessions, and that's Portfolio Shield. I'll put a link up here in the corner and the description below. And of course, our own chief strategist, Jeff Snyder, he stands behind this, saying that this strategy is what works during deflationary markets, which he says is coming soon. Let's continue on, because I want to show you how powerful the yield curve inversions are and what they mean for lower home prices. And here we'll note I've got all transaction home prices in the U.S. on a year-over-year rate of change overlaid against the yield curve. So here we see an inversion. Now this yellow line that I crudely drew in here is where home prices go negative. And so you'll note it did go negative following these inversions here in the early 80s. Now it didn't go negative following the inversion here in the late 80s, and housing remained fairly robust there. You can thank the baby boomers for that trend, but look what happened during going into the financial crisis. You see a yield curve inversion and home prices go negative. Here we're seeing another curve inversion, and people believe that home prices are sticky, are going to stay high. The history kind of suggests that unless there's a big demand for housing that can keep pushing this up and wages are going to drive it, like we saw when baby boomers were driving the housing market, well, the probability suggests that housing prices are indeed heading lower. And what does our own chief strategist, Jeff Snyder, say about this? Well, in his daily brief today, and I'll remind you, you can sign up for this, it's free. I don't know how, free for a limited time in the description below, Markets Insider Pro. Check this out. Here's what he had to say today. Interpreting the National Association of Home Builders Index, the consensus surrounding the quick retreat in the housing and real estate market is rising interest rates spoiling last year's "you must buy hard assets to shelter from inflation" fever. The quotes from the NHB chairman accompanying the July press release suggest quite a bit more. And another sign of a softening market, 13% of builders in the HMI survey reported reducing home prices in the past month to bolster sales and or limit cancellations. Either way, as the U.S. CPI reaches another 40-year high, suddenly demand for inflation protection assets is falling dramatically. This must mean real estate investors are rejecting the rising cost of their inflation protection because, one, they now believe inflation is going to be less of a threat or less of a durable threat, and two, demand for real estate is being reduced by other factors which contribute to the self-reinforcing loop, with number one, like the crypto crash, more than a hint of transitory. And what I love about Jeff is he looks at the world from a different way and saying, look, wait a minute, maybe things here don't make sense, because what we're now seeing is home prices come down, and California is leading the way as California home sales plunged 21% as soaring mortgage rates hit. The pace of purchases in June was down the most since May of 2020, when the pandemic lockdown was in full effect. And here you can see the home sales data coming from California posting its biggest drop since May of 2020. And notably, it's fairly broad-based. This is a surprise to me that under 300,000, it saw the biggest drop in deals, suggesting that perhaps those who are new home buyers or entry-level home buyers, they're priced out of the market. But we've seen in the past that didn't matter because the wealthy were driving the market. But here, look at this again. You'll note 25% drop, 22% drop here in the $5 to $1 million range, and even over $2 million, a 20% drop in the pace of sales. as single home family prices in the most populous state fell to a median of $863,000 in June, down 4%. So again, prices have fallen from the all-time high of $900,000 set back in May. Prices were still 5.4% higher than a year earlier, although other signs pointing to a cool down include fewer pending sales, a growing inventory of available homes, and a shrinking share of deals closing above the asking price, suggesting that if you've got your home for sale, well, perhaps you may not get exactly what you want. But there may be some hope for those who are trying to sell because foreign buyers are back. As foreign buyers return to the U.S. housing market after a 3-year drought and after 3 straight years of declining sales, buyers from other countries purchased a whopping $59 billion worth of U.S. homes, perhaps as they're looking to get out or get their money out. The average price of a home purchased by a foreign buyer jumped 18% to nearly $600,000, with the increase pushing up the total dollar volume, even as the number of existing homes sold slipped to the lowest level since 2009. Among foreign buyers, 44% paid cash, looking as they get their money out of where it's at, compared to 24% among all purchases. And here you can see the countries where people are leaving or trying to get their cash out of: Canada, Mexico, China, India, Brazil, and Colombia, in that order. And housing starts in the U.S., as we looked at today's data, declined to the lowest level since September, as groundbreaking dropped 2% to 1.56 million pace in June, as single-family construction permits fell to 2-year lows. And this is following last month's data where they were negative. We covered that. And so we're seeing not only now is sales slow down, we're seeing permits, starts, construction issues. It's all leading to a big slowdown in housing. And as our chief strategist, Jeff Snyder, points out, maybe it's not what you think it is. Perhaps we're actually dealing with a major dollar shortage. Let's continue on, because starts and permits as single-family homes slid to 2-year lows, adding to an increasingly downbeat picture for the housing market. A sharp rise in mortgage rates, spurred by aggressive actions by the Federal Reserve to curb inflation, has crushed affordability and curbed demand. As a result, inventory has increased, housing deals are falling through, and some sellers are now even cutting prices. And here you can see why these permits matter, because what we're looking at here is private housing authorized by building permits in blue, and what you see below that is U.S. privately owned housing units started by structure in green, and they go together as they fall, as one heads down, and usually it's permits leading starts, because you can't start a home without a permit. And last, let's wrap up today's show, because there's really something neat in today's note from our chief strategist, Jeff Snyder. He gives us a deep dive into something a lot of people don't understand. And I was recently on their show talking on Emil Kalinowski's show and Jeff Snyder's show, talking about this very subject. And then today, Jeff Snyder goes deeper into it. If you're wondering who I look to, who I learned from, well, this is a guy, and currently it's free. Let's take a look at this real quick. As overseas officials selling treasuries? What's the deal with that? The Federal Reserve Bank of New York reported late last week that the balance of U.S. Treasury assets held in custody by the branch as an accommodation on behalf of mostly foreign central banks and governments declined to $2.96 trillion for the week of July 13th. That's down by more than $170 billion since March 2021, when the yield curve began to flatten at longer-term calendar spreads. Now, if you're wondering what all that means for the bond market, if it's bad news, well, it doesn't mean that at all. Jeff goes deeply into this. Pair that with a video interview that I did with them, and you'll have a deep understanding and be much smarter and understand perhaps why that this issue in the housing market, as Jeff points out, is not just a function of interest rates, as we talked about, or the stock market, but it has everything to do with the yield curve inversion, and that means there's a massive dollar shortage. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.